Hello and welcome to our new Wilkins Southworth video. I'm Chris Wilkins. At Wilkins Southworth, we always explore the problem to ensure that you get the most proactive and best tax advice.
Basis period reform. Adjustments from April 2024. Many of those self-employed or working for an unincorporated business would have been buoyed when the government announced a delay in the Making Tax Digital for Income Tax Self-Assessment (MTD) ITSA regulations. The new date of April 2026 was announced, which must surely mean a delay in the accompanying basis period reform. Unfortunately, this was not the case, with the basis period reform still going ahead with effect from April 2024. In theory, it is a relatively straightforward reform, but in practice there are several factors to consider, such as proportioned profits and overlap profits brought forward. Who is affected by basis period reform? Before we go any further, it is crucial to identify the relevant parties affected by basis period reform. It is the self-employed, sole traders and partnerships with an accounting period which does not end between the 31st of March and the 5th of April. So if your accounting period ended on the 31st of March, you won't be impacted. If it's the 6th of April, you will be. What is the idea behind basis period reform? The idea is simple: to bring the self-employed and partnerships into line with the tax year end for profits. As we will cover in a moment, no legislation will force you to change your business year end. However, from 2024-25 going forward, you will be taxed on your income over the tax year, even if you still maintain a business year end outside the 31st of March to the 5th of April. At first glance, it may be difficult to understand why someone would look to maintain a business year-end outside this period. They will need to apportion profits from different business accounting years each year, which can get complicated. There may be a reason why the business needs to retain a particular year-end. For example, it might be quieter and the best time to carry out stock taking without impacting normal business operations. Basis period reform, the basics. The 2023-24 tax year is a transition period after which self-employed and partnership businesses will be taxed on their income over the traditional tax year. To effectively rebase this charging period, those affected must extend their last accounting year to the 5th of April 2024. This means they will be taxed over an extended period. However, to minimise the impact on cash flow, an element of the taxable profits is staggered over a 5-year period. Some businesses will be able to use what is known as overlap profits, which are profits from the early days which may have been taxed twice. Before moving on to transitional profits and the realigning of year-end dates with the tax year, we will briefly examine overlap profits. This anomaly only occurs when a business year-end is not in sync with the tax year. Example: business accounts period 1st of January to the 31st of December. If the business commenced on the 1st of January 2021, a portion of the full year profits would be taxed at the tax year end, 5th of April 2021, for the tax year 2020 to 2021. So when the full year accounts are produced from the 1st of January 2021 to the 31st of December 2021, 3 months of profits will be used as the basis for tax for the 2020-21 tax year. Assuming the company made profits of £120,000 in the full year, then £30,000, 3/12 of £120,000, would be apportioned to the 2020-21 tax year and taxed accordingly. The overlap occurs in the following tax year, where the profits for the full 2021 calendar year, i.e. £120,000, would be used as the basis for the tax calculation for the tax year 2021-22. So in effect, £30,000 of profit has been taxed twice, in each of the tax years in question. Therefore, The business is carrying forward overlap profits of £30,000, typically used if the accounting period is changed further down the line or the company closes/ceases trading. In effect, the business is reclaiming back tax on the double-taxed £30,000 profit. In the following examples, while we haven't directly considered overlap profits, they would be offset against profits in the transitional period. Transitional profits. We now move on to calculating transitional profits, where a sole trader or partnership has a year-end outside of the period between the 31st of March and the 5th of April. There are several scenarios to consider, such as constant profits, increasing profits, decreasing profits, extended accounts or full year and partial accounts. A lot to take in. Stagnant, increasing and decreasing profits. So, from the 2024-25 tax year, all sole traders and partnerships will be taxed on their profits between the 6th of April and the following 5th of April. We will now look at the transition period and how a change in profits will dictate the correct route. Stagnant profits. Where profits are stagnant, for example £10,000 a month, it makes no difference whether you create one set of accounts covering 15 months or two sets covering 12 months and 3 months. The calculation will be as follows. One set of accounts. Over the 15-month period, making profits of £10,000 a month, the total profits would be £150,000. If we prorata the profits on a 12-month and 3-month basis, we would arrive at the following figures. 12-month profits equals 12/15 times £150,000, which equals £120,000. Transitional profits equals 3/15 times £150,000, which equals £30,000. As the transitional profits are taxed over a 5-year period, in this instance, the figure would be £6,000 a year. So during the period under review, tax will be calculated on profits of £120,000 plus £6,000, which equals £126,000. Two sets of accounts. By creating two sets of accounts, we can identify the profit breakdown as follows. 12 months profits equals £120,000. Transitional profits equals £30,000. Spreading the £30,000 transitional profits over 5 years equates to £6,000 a year, with taxable profits for the extended period as follows. £120,000 plus £6,000 equals £126,000. As the profits are constant over the 15-month period, there is no heavier weighting towards either the first 12 months or the transitional period. Consequently, the taxable profits are the same, whether working from two sets of accounts or an extended set of accounts covering 15 months. Increasing profits. In the following example, we will assume that in the calendar year 2023, the business makes a profit of £120,000, with profits increasing to £20,000 a month during the 3-month transitional period, January 2024 to April 2024. One set of accounts. Over the 15-month period, the 1st of January 2023 to the 5th of April 2024, profits would be £180,000. Then we need to break this down on a pro rata basis into the 12-month period and the transitional 3-month period. 12-month profits equals 12/15 times £180,000, which equals £144,000. Transitional profits equals 3/15 times £180,000, which equals £36,000. As the transitional profits are spread over 5 tax years, to minimise the impact on cash flow, there is a further calculation, £36,000 divided by 5, which equals £7,200. Consequently, during the 15-month period from January 2023 to April 2024, the business would be taxed on profits of £151,200. Two sets of accounts. If we use two sets of accounts, using the above example, there would be a profit of £120,000 in the full year, with a profit of £60,000 in the 3-month transitional period. Therefore, the profit calculation for tax purposes is as follows. 12 months profits equals £120,000, transitional profits equals £60,000. As the tax charged on transitional profits is spread over 5 years, the taxable profit for this period is £60,000 divided by 5, which equals £12,000. Therefore, for the extended 15-month period, tax would be charged on profits of £132,000. In this instance, as the greater monthly profit occurred in the transitional period, which is then spread over 5 tax years, there is a benefit in doing 2 different sets of accounts. Decreasing profits. In the next example, we will assume that in the calendar year 2023, the business makes a profit of £240,000, with profits reduced to £10,000 a month during the 3-month transitional period. One set of accounts. Using the figures above, we can see that over the 15-month period, profits came in at £270,000. To calculate the taxable profit, we need to pro-rata this into a 12-month period and a transitional 3-month period. The calculation is as follows. 12 months profits equals 12/15 times £270,000, which equals £216,000. Transitional profits equals 3/15 times £270,000, which equals £54,000. As the transitional profits are spread over 5 tax years, to minimise the impact on cash flow, there is a further calculation, £54,000 divided by 5, which equals £10,800. Consequently, if we pro-rata profit over a 15-month period, the taxable profits would be £216,000 plus £10,800, which equals £226,800. 2 sets of accounts. We will now look at the difference in taxable profits using 2 sets of accounts, 12 months and the 3 months transitional period. Using the above information, we know the split is as follows. 12 months profits equal £240,000, transitional profits equals £30,000. We now need to spread the transitional profits over a 5-year period as follows. £30,000 divided by 5 equals £6,000. As we aren't using pro-rata profits over a 15-month period, the tax is more heavily weighted to the first 12 months, with tax paid on the following figure. £240,000 plus £6,000 equals £246,000. Should you go with 1 set or 2 sets of accounts? When it comes to basis period reform and the use of 1 set or 2 sets of accounts, the following summary should help. Constant profits, there is no difference using 1 set or 2 sets of accounts. Increasing profits, as profits are weighted towards the transitional period and the tax charge spread over 5 years, it is better to use 2 sets of accounts. Decreasing profits, in this instance using 1 set of accounts would help, increasing the element of pro-rata tax in the transition period, with the tax charge spread over a 5-year period. There are other issues to consider, such as the cost of producing the accounts, relief allowances, overlap profits, etc. Therefore, you must take advice from your accountant. Basis period reform summary. On the surface, what may seem a relatively straightforward transition period becomes more complex if the profitability of your business were to change between the traditional year-end and the transitional period. The above examples show the benefits of using 1 and 2 sets of accounts and the calculations for reference. If you have any questions regarding basis period reform, then please visit our website and leave a message. We will then get back to you as soon as possible. By the way, don't forget to subscribe to learn about other videos in this series.